Okay, welcome, ladies and gentlemen, to our session today. Right, my friends, I think for the rest of this June and most of July, this session will be on Mondays at this time. Very sorry for continuously shifting you. It is because I didn't want to inconvenience your weekends, and my semester classes, which I used to do at this slot, have returned. So that's why I've thought maybe this slot can be better. So we'll be using, and instead of using that other Thursday that I said 8 o'clock, it's rather better that we do earlier and finish earlier. So we'll be using this slot for the whole of this month and probably July, because I think my next semester will only start towards end of July or beginning of August. So that's when we might return to the original Saturday slot. But for now, I think every Monday, that's when we'll be doing text. Right. And another thing, we have got a forthcoming test during the month of July. So we need to be fully prepared for those tests. So because of that, I'm going to be doing double classes on Monday, and then I will be giving you another one on Saturday. On Monday and Saturday, Monday and Saturday, depending on my schedules, if there's load shedding and stuff like that. Maybe I might even say Sunday, but we'll be doing 2 classes. We're very sorry those who might miss 1 or 2 classes. All classes will be recorded. Then you'll be able to access the recording. Then I will give you another break, I think sometime in July, because from August until you write, I think you might not even get a break. Maybe you might even get 1 break or stuff like that. So those breaks, I will be doing it so that you at least refresh rather than to have the whole year learning. So I will give you another break in July. I think I will try to make sure that maybe for all the modules I give you in the same week, so that you have 1 week that you relax. But prior to that, we'll be doing double classes so that we can cover up and be ready for the next test. All right. If you still remember, the taxation of businesses, I just did it fast in the revision for the sake of the test. So I've decided that maybe I do it nicely now, but we've already done it. Actually, the taxation of business, you have done almost everything. We did it through when we were doing the income of a business, then when we did the expenses of the business separately. So now we'll be integrating those incomes and expenses and doing them one time to see how we calculate the income tax liability of a business entity. Right. There are about 4 variations that you need to be able to do. Right. Number 1, we have to be able to calculate tax for a normal company and for a small business corporation. Right. And you should know that the major distinctions, whether it's a company or small business corporation, are the capital allowances. Remember that a small business corporation can claim capital allowances in terms of Section 12E. Right. So so you have to be able to do. And number 2, the rates for a small business corporation, if the taxable income is lower, the rates can also be a little bit lower. So those are the 2 major distinctions. So we should be able to calculate for a small business corporation and for a company. So you find that all other incomes, all other expenses, the treatment is the same, whether it's a normal company or a small business corporation, except for those capital allowances, whereby if it's a small business corporation, then we'll have to apply Section 12E. I think you shall see it today. I will be reminding you those concepts because I know that some of you, you have forgotten them. So as we go deal with those expenses, I will be reminding you the concepts related to the particular expenses. So that's number 1. We have to be able to calculate for a small business corporation and for a company. That's why you see that the 2 questions that I've selected, 1 is for a small business corporation and 1 is for a company. Right. Then number 2, under each, you should be able to calculate your tax starting from either the profit before tax, which is given, or starting from scratch by recording the transactions one by one. So we should be able to calculate the tax by recording the transactions one by one, and also you can be asked to start from a accounting profit that is calculated. So there will be differences there, as you shall see. That's why one of the questions that I've selected will be starting with the transactions one by one, and the other one will be starting from the profit before tax. So that's the reason why I've selected those questions as such. So please, I said, be able to calculate the one for a small business corporation and for a company. And also, you should be able to start from the profit before tax and recording transactions one by one. There will be differences there, and you should be able to account for those differences. Right. So now I will now be continuing with I'll start from the questions. So this topic that we're doing is basically applying what we learned from the beginning, except those things to do with individuals. So that means we should be able to apply to know which items are taxable and in what manner are they taxed as we go. Right. So our question one. This question comprises of two independent parts, namely part A and part B. Right. I've only incorporated part A because that's the part that I needed to look at today. Right. Barika Private Limited. Barika is a recruitment agency specializing in locating young entrepreneurs in rural areas. Their main business focus on Gauteng and the surrounding areas. The company is a small business corporation. This is key, my friends. This is a small business corporation. So that means number one, for capital allowances, remember that a small business corporation has got an election to either choose the Section 12E or the normal capital allowances. And from a tax point of view, it is advantageous to use the Section 12E. So that's why normally when they ask you to calculate the tax of a small business corporation, you should know that on capital allowances, we should apply Section 12E allowances. Always, because they are more advantageous than the normal ONT allowances. And you should also remember that when it comes to buildings, the capital allowances are the same, whether it's a normal company or it's a small business corporation. Right. And its financial year ends on the last day of December. Right. This is very important when it comes to things like prepayments. We know that there can be special treatments that can be there. Right. Barika is a registered VAT vendor making only taxable supplies. All amounts exclude VAT unless otherwise stated. So they already exclude VAT. Right. We should remember that for a VAT vendor, when we are calculating the taxable income, all amounts should exclude VAT. All amounts should exclude VAT. Why? Because the VAT that they receive is not their money. They are supposed to surrender it to SARS. And the VAT that they are charged, that is the VAT input, they can claim it from SARS. So as such, they cannot treat them as incomes or expenses. So when they record their incomes or expenses, they should be excluding VAT. So that means if we find anything which includes VAT here, we should take out the VAT because it should exclude VAT as long as the business is a VAT vendor. But if the business is not a VAT vendor, then even if they're including VAT, you leave them like that. Why? Because the business will not be able to claim the VAT from SARS. Right. You are provided with a list of income and expenses of Barika for the financial year ending on 31 December 2018. Right. Then required calculate the normal tax liability of Barika Limited for the 2018 year of assessment. Do not start with the net profit before tax and do not make any accounting adjustments. Calculate the normal tax liability by starting with income, service fees, ignore any capital gains, tax implications, and social or calculations. So in this particular case, we're not going to account for the capital gains tax, even if they are there. So we will not account for capital gains tax, even if it's there. Right. The company make additional information. The company made a first provisional tax payment of 80,000 on 30 June 2018 and the second provisional tax payment of 75,000 on 31 December 2018 in respect of the 2018 year of assessment. Companies are normally required to make what are called provisional tax payments. I think you know that the main source of revenue for the government is the tax, and the taxable income of companies will only be certified, or will only be sure about it after the year end. Normally, that means normally you'd know that when the year ends, that ends in December for this particular company, they will need time to prepare the financial statements, probably January or so. And then maybe by the end of January, that's when they can be able to have their tax returns. So the government in the meantime needs money. So for that money to be there, they require these companies to make provisional tax payments. The first payment is made 6 months into the year. I think we looked at that sometime before. That means for a company that has got a 31 December 2018 year end, that means they made the first provisional tax payment of 80,000 on 30 June 2018, which was 6 months into the financial year. Then at the end of the year on 31 December, they make the second provisional tax payment. Then after verifying, they will then check if they still owe SARS, then they will have to pay the remainder. So what will happen here is, well, suppose when you are with such a question to calculate the normal tax liability, first of all, calculate the taxable income. After calculating the taxable income, then apply the tax rates of a small business corporation, because we're dealing with a small business corporation, to calculate their income tax expense. After calculating that income tax expense, then you subtract the provisional tax payments that they've made. That is the 80,000 and the 75,000 for you to arrive at their income tax liability. You should be able to know where to end when you're answering these questions. They can ask you to calculate the taxable income. If they just said calculate the taxable income, you don't have to calculate the income tax expense. You just have to calculate the taxable income, then that's it. They can then also ask you to calculate the income tax expense. If they say income tax expense, that means first you calculate the taxable income. After calculating the taxable income, then you apply the applicable tax rates, depending on whether it's a normal company, it's just a normal company, or it's a small business corporation. Then you calculate your tax expense, then you are done. But then if they say tax liability, that means first you have to calculate your taxable income. After calculating your taxable income, calculate your income tax expense. After calculating your income tax expense, then deduct any provisional tax payments that will have been made. Right. Any questions before I proceed? Right. So please, I will make sure that you are not very much 100% lost by trying to explain some of the expenses and incomes that we dealt with in our previous classes. Right. Businesses. Calculation of normal tax liability of ended for the 2018 year of assessment. We are not in accounting here. In accounting, that's where we normally talk about the year ended. Right, my friends? Normally, we need one big column for the details. Then we need 2 to 3 columns for our final figures will be in the third column. These 2 can be for calculations. We might just need 2. but to be safe, you can just make sure that you provide for 3 columns. Is that right? Even if you don't use it, there's no harm. Is that right? So you just provide these columns. These first 2 will be for any workings. For example, if you sell an asset here, you might put the selling price. Then in this column, you might calculate the tax value. Then after calculating your tax value, you export it to the second column. Then you find the difference between the 2 to get your scraping allowance or your recoupment, which you will then post to the third column. Right. So 2 to 3 columns for monetary amounts will be enough when you are calculating your taxable income. Right. Right. Would start from the first item. There is a income from service fees, 1890. Normally, if there is no note, as long as it's a taxable income or it's a deductible amount, you just have to include it as it is. Of course, we know that we've got some things that are not taxable. For example, dividends received. Right. So if there is no nothing, we just have to record it as it is. So we'll have our service fees. And 890. Right. Please, if there's a right, if it's income, we add. If it's a deductible item, we subtract. We put it as a negative. Right. Then we have next, we have got expenses. So in expenses, normally we expect them to be under deductibles. Right. Advertising, they put a number 1 here. So if there is a note, before you record, you should make sure that you read what they are talking about. Right. Here there's number 1. Barika paid an amount of 23,000 to an advertising company to create posters to advertise its business to local entrepreneurs. Right. What we just have to check here is the advertising incurred in the production of income. Remember that when we are defining deductible expenditure, it should be for the production of income. So as long as they are advertising their business, that means this amount is deductible. It has to be shown as a deduction. But if it was not for the production of income, those advertisements had nothing to do with the business, they were not going to be deducted. So that means here they are for the production of income, so we can deduct the advertising expenditure. That means we deduct that amount of 23,000. Right. Then salaries. Right. We know that employee benefits, such as salaries, pension contributions, contributions to other funds, they are deductible for tax purposes. So salaries 500,000. Right. Then there is insurance. We are referred to number 2. Now, if we go to number 2, we are told that Barika took out a Keyman insurance policy. For the death, disablement, or illness on one of its key employees, Mr. Jojo, on 1 June 2018. The company pays 560 per month for the policy. Right. Then the employee is the beneficiary of the policy that is owned by Barika, and the premiums are included in the employee's gross income. Right. Right. Now, when it comes to keyman contributions that is made by the company, there are grounds upon which they can be deductible. Right. They will be deductible if they are included in the employee's gross income, and they are for the benefit of the employee. So that means this amount can be deductible. Right. But we have to know that they took out this insurance on 1 June, and our year is ending in December. That means the keyman insurance was not for the full year. Right. So it was not for the full year, so it was from June. So June to December, that means for 7 months. Right. So we would say insurance applied by 7 months. So you should be very careful. That year, they didn't say 560 for the full period. They said 560 per month. So we have to know how many months are there. Remember, our year of assessment is ending in December. So June up to December, that means 8 months. So we get 3920. Thank you so much. So please, guys, it's not always that this keyman insurance will be deductible. For example, if they told us that the keyman insurance was not included in the taxable income of the beneficiary as a fringe benefit, then it was going to be disqualified as a deduction. So please, those are some of the principles that I want you to make sure that you understand. Is that right? So you should know that it's not always that this can be deductible. So read properly and understand what is given. Right. Then next, restraint of trade. Right. We should know our principle that if you know what is the restraint of trade? Maybe an employee is working for the company and he decides to leave. We know that sometimes key employees, they've got strategic information that if they can go out there and use it against the company, our competitiveness can weaken. So to avoid that, companies, they sometimes pay what is called the restraint of trade. So you are saying to the person, for the next 2-3 years, you are not supposed to work in the same field or in an environment that competes against us, so that you don't give wherever you're going an unfair advantage. So a restraint of trade stops the person from working in a way that disadvantages the company or in the same field. Right. So with a restraint of trade, we have to know our principles. That a restraint of trade, as long as the years are 1 or 3 or more, we just have to spread it over the number of years of the restraint of trade. For example, if we say the restraint of trade was for 7 years, we will deduct the amount annually for 7 years. We'll spread it over the 7 years. All right. So as long as the years are 3 or more, we'll just use the number of years. But if the number of years of the restraint are less than 3, then we just use the 3 years. Is that right? So the deduction is the lesser of the amount divided by the number of years of the restraint, or a third of the amount. I will show you. Right, let me just show you here. And also a restraint of trade should constitute income in the hands of the beneficiary for it to be deductible. Barika made a restraint of trade payment of 450,000 to one of their lead recruiters, Mr. Chauke, on 31 August 2018. Mr. Chauke was restrained from competing with the company for 2 years from the date of the payment. Only 400,000 will constitute income as defined in the hands of Mr. Chauke. Right. Number one principle, my friends, for the restraint of trade. We can only deduct it to the extent that the amount constitutes income in the hands of the beneficiary. So we made a payment of 450, but they are saying only 400 will constitute income in the hands of Mr. Chauke. So when we calculate our deduction, we are limited to that 400,000. Right. So we're saying here, because normally sometimes they need you to write the principles. Right. Limited amount constituting income in the hands of Mr. Chauke. That is 400,000. So when you calculate although the restraint of trade was for 450, we are only going to use 400,000. You only have to limit it to the amount that constitutes income in the hands of the taxpayer. Right. In another thing, the minimum period for writing off this amount is 3 years. And another thing, this amount is not apportioned. It is not apportioned. So what do we mean here? We mean although this payment was made on 31 August, we're not going to count the months and say September to December, 4 months. We just divide over the years. It is not apportioned. Right. So a deduction is limited to the lesser of a 400,000 divided by 2, which is equal to what? 200,000. Where is my 2 coming from? This restraint of trade was for 2 years. It was for 2 years. Or 400,000 divided by 3, which is equal to what? Please confirm if I'm correct here. Is it 133333? Confirm if I'm correct there, my friends.
Yes, you are correct, sir.
Thank you, boss. So that means we're going to deduct a 133,333. So that's what I was saying, that as long as the years are 1 or 2, you use the 3 years, because obviously the 1 divided by 3 will be the lesser. But if the years are 3 or more, you just use the actual years, because the actual years will be lesser. For example, if it was 4 years, 400,000 divided by 4 is 100,000, which is less than 133,333. So as long as the years are 3 or more, we know that the lesser will be the actual years. But if the years are 1 or 2, you would have to divide by 3. So that means they will have, although the restraint was for 2 years, but for tax purposes, they will have to claim the deduction for 3 years. Over 3 years, not 2 years. Any questions on the restraint of trade? And as I said, although it was paid on 31 August, we only had about 4 months to the end of the year. But this deduction is not apportioned. So we don't have to take into account the number of months. Any questions on the restraint of trade? So please, those are the things that I want you to understand are the principles. Because we find that when you are writing a test or when you are writing an exam, the figures may not be the same. So you have to know those principles that we limit it to the amount of that constitutes an income in the hands of the beneficiary. And there is no apportionment. The deduction is limited to the lesser of the amount divided by the number of years, or the amount divided by 3. The 3 is standard. It will be the other option, but the other option will be divided by the actual number of years of the restraint. So you compare the divided by 3 and the divided by the actual number of years of the restraint.
Hello, sir.
Yes.
So is it only deductible just on the first year, or even the following year they can still?
Annually. So that means they are going to claim this 333 for 3 years until the 400,000 is done.
Okay.
So next year, 2019, they will claim another 133,333. And in 2020, another 133,333. So the full amount will be deductible, but it will be deductible in installments.
Okay.
Any other questions? Right. So please make sure that you are getting the principles that we are applying here, because those are the ones that will affect you. Right. Lease payments. There's bad debts first. Right. Bad debts, remember that bad debts, they are deductible as long as they are for the purposes of trade. Bad debts are deductible as long as they are for the purposes of trade. But the allowance for bad debts, usually it depends on whether the entity is applying if it's 9 or not. Right. We know that if the debts have been owing for more than 60 days to 120 days, then you would apply the 25% of the doubtful debts will be deductible. And if they are owing for more than 120 days, then you would apply the 40%. That is if we're given the number of debts, the number of days that the debts have been owing. But bad debts, as long as they are for the purposes of trade, they are supposed to be deductible. When we say they are for the purposes of trade, that means we're talking about a bad debts for sales that we made. Like in this case, they are giving, they charge service fees. That means bad debts for service fees are supposed to be deductible. That means if a customer disappears or dies without paying us, then we have to deduct any bad debts in total. But if the bad debts are not for the purposes of trade, they are not deductible. For example, my friends, businesses, they can give loans to their employees. And if the employee leaves employment without paying and he goes without trace and we write off the loan, that loan will not be deductible because it was not for the business, for the trade of the company. Unless if the company is let's say a financial institution that provides loans and the loan was just provided as part of its business, then it can be deductible. But for any other business, such bad debts will not be deductible, only those that relate to the business. So for an amount to be deductible as bad debts, it should have been included in the income of the business. For you to understand this, whenever you write off a bad debt of a customer, then remember that first of all, what first happens, when you sell to them, you record that income in your sales. So it will have been included in the taxpayer's income. So for an amount to be deductible as a bad debt, it should have been included in the income of the taxpayer. Right. So as a consequence, we're saying these bad debts, they are fully deductible. What you only have to know is we're dealing with the 2018 year. So that means this 8,000 bad debts is deductible without question. Let's see if there's anything else. they said an allowance for doubtful debts was allowed by SARS in the previous year. Okay. So our bad debts of 8,000, they are deductible. Since we're not told about any other thing about them, we assume that they are for the purposes of trade. So we'll say bad debts, 8,000, that's deductible. Right. Then here they didn't give us the breakdown of the number of days that these doubtful debts have been owing. Right. If we don't have that, we can just apply the general rule that 25% of the doubtful debts are allowed as an allowance by SARS, if we are not given anything about the breakdown. But remember, I said that if they are more than 60 days, less than 60 days, normally we don't provide. But if they are 60 days to 120, then we would provide 25%. If they are more than 120 days, then we would provide 120 or more days, we would provide 40% as an allowance. But as I said, in this particular question, considering that they didn't give us the breakdown, I think it was because the question that I've chosen, it's a little bit older. By that time, they'd not given those rules of the IFRS 9 and no IFRS 9, they came later, right? So what will happen here is that the allowance, when you're dealing with the allowance for credit losses, just like in accounting, the allowance for last year will have to be added back to your income, and allowance for this year will have to be subtracted. I repeat, the allowance for last year, add. The allowance for this year, you subtract. So we calculate last year is 2017. So 25% of the 18,000 will be added back. Then the 25% of the 25,000 for this year will be subtracted. So we can say allowance for doubtful debts, for doubtful debts, (2017) that's 18,000 times 25%. What do we get? Thank you, guys. 4.5. So the one for last year, you add back. So it's just like accounting. Remember, we just take the difference. Then the one for this year, 2018, which is the 20,000, the 25,000 multiplied by 25%. What do we get? $6,250. Right. Alternatively, you can just put it as one figure. You can just say 25,000, the one for this year, minus 18,000. Then multiply by 25%. Then you just put one figure without breaking down into 2017 or 2018.
Eugene?
It will still be acceptable. Yes.
Are we not subtracting the 6,250?
It's subtracted. Thanks.
All right.
Is that right? So alternatively, you can just find the difference between the list for this year and the list for last year. So to know whether you should subtract or add, as long as the list is going up, then we deduct. If it's going down, we add. So you can, it's acceptable also to just do one entry by just looking at the difference between the doubtful debts, then multiply by 25%. That is if we don't have those complications of more than 60 days, more than 120 days.
Mr. Eugene, the 25% is from where again?
It's a standard according to the Act.
Oh, all right.
But as I said, if the give you the breakdown of the days. You would know that those days that are 60 days to around 119 days, you would use 25%, and those days that are owing for 120 days or more, you would then use 40%. All right. So those ones are in the act. Any other questions on this? Well, I will remove this, my friends. I was just illustrating so that maybe those who are not in class, when they see it, they might become confused at the end of the day. So I'll just leave it like that so that we just use one approach here. Right. Then number 5, lease payments. Right. Already when you are dealing with lease payments, you know that there are usually 3 things that you can deal with. Three or 4. There is the lease rent. When you are renting, the rent is deductible as an expense. Then there can be also the what you call a lease premium. Lease premium. The lease premium is normally deducted on the lease period. That is, we don't normally just deduct it in the year that you pay it. It's normally deducted over the period of the lease. If the lease is for 10 years, you then have to deduct it by 10 years and annually claim an amount. But we should also know that the number of years that we can allocate the lease premium is limited to 25. So if the lease is for more than 25 years, you just use 25 years. Is that right? Right. That is for the lease premium. So the lease rental, you just deduct it as it is for the lease premium, spread it over the period of the lease. Then we've got what we call obligatory lease improvements. This is when the lessee is obliged to make improvements to the property of the lessor. Then these obligatory lease improvements, you can also claim a capital deduction for that, but it is spread over the remaining period of the lease from the date that the improvements are brought into use. So you just have to spread them over the remaining period of the lease from the date that the improvements are brought into use. So I'm saying these are the things that already, before you even read, you know that these are the things that I can expect. I can expect lease rental, I can expect lease premium, I can expect leasehold improvements. Right, so now let's go and check what is there in this particular case. Right, Barika entered into a lease contract with Rent Private Limited to occupy an office building from 1 February 2018 for a period of 5 years. So that's 5 years. The lease agreement stipulates the following: a rental per month of 8,900. So as I said, the rent is deductible, no question to that. Of course, we know that if there are prepayments, then we have to do those tests, right? But if it's just rent for the period, we just have to deduct it. So our rent is 8,900 per month, and the rent, they started renting in February. Remember that our year is ending in December. So for the current 2018 year of assessment, they rented for 11 months, 1 February to 31 December, which is 11 months. So we can say rental $8,900 times 11 months. What do we get? $97,900. Thank you so much. We deduct that. Right. Then number 2, there was Barika is obliged to effect leasehold improvements of 340,000 to the office building. Right. The leasehold improvements commenced on 1 March and were completed at a cost of 320,000 on 31 October. The improvements were brought into use on 31 October 2018. Right. Leasehold improvements. Right. The deduction is limited to the lesser of the actual leasehold improvements cost, which is in this case we were told that the actual cost was 320,000. Or not is limited. Let me say is based, because we don't actually subtract the full amount there. Let me just change my wording here. On the lesser. Or the amount is agreed in the contract. Let's say and the amount is agreed in contract, which is what? 340,000. So that means if you spend less, your deduction will be based on the actual amount spent, because we use the lesser. If they had spent more than 340, the deduction was only going to be limited to 340. That is the obligation that they had. So in this case, the deduction will be based on the lesser amount, which is what? 320,000. So you find the lesser of the two, the actual amount or the agreed amount in the contract. So we'll calculate, it's not that you will deduct the 320, but our deduction will be based on the 320, right? Now you should know that the deduction will be allocated over the remaining. You don't have to write all these things when you're in the exam. Of course, the first one of that is limited to the lesser, you have to write it. But what I'm writing here, you don't have, if you're in the exam or test, you don't have to write it, but it's for you so that you understand the principle, right? The deduction will be allocated over the remaining lease period. From the date the improvements are brought into use. And remember our limit. Remember we said that there's a limit of 25 years. So it doesn't exceed 25 years. So we can say limited to 25 years. So in this case, we know that the lease was for 5 years, my friends. The lease here, we're told that it was for 5 years. Right, the lease was for 5 years. But the improvements, they were only completed, they were brought into use on 31 October. That means the lease had already been there for 9 months. So of the 5 years, 9 months had already gone. Where am I getting my 9 months? From 1 February 2018, the beginning of the lease, up to 31 October 2018, it's 9 months. So that means the lease was only left with 4 years and 3 months. The lease was only left with 4 years and 3 months. I've taken out the 9 months from 1 February when the lease started up to 31 October when the improvements were brought into use. So 9 months had gone. So we're left with what? With the 4 years and 3 months. And during the current year, the improvements were in use for 2 months. Where is my 2 months coming from? Right. That means they were brought into use on 31 October, and we had November, December, then our year end. So during the year, they will only use these improvements for 2 months, from November to December. I'm not including October because the improvements were ready on 31 October. So we only used them for 2 months. So to calculate our deduction, my friends, would say, so that means our deduction would be 320,000 multiplied by 2. The 2 is for months. Maybe let me write 2 months. That is November to December 2018. I'm writing this for you so that when you are alone, you don't get confused. Right. Then divided by what? Divided by 4 years and 3 months. If you say 4 years, it's 4 times 12, which is 48. 48 months. Then plus the other 3 months, that means 51. Is that right? So please remember that the 51 months is the 4 years and 3 months, which was remaining from the date that the improvements were brought into use until the end of the lease term. So you spread over the remaining term from the date that you the improvements are brought into use. 12,549. Before I proceed, any questions on the leasehold improvements?
Please repeat the 3 months you're talking about, sir. The 3 months.
I said 4 years and 3 months, not 3 months. Right. Remember, we said this lease started on 1 February, but the improvements were ready on 31 October. So from 1 February to 31 October 2018, it was 9 months. So by the time that the improvements were done, the lease was already 9 months into the year. Is that right? But we know that the lease was for a full period of 5 years. So if we say 5 years minus 9 months, 5 years minus 9 months, we remain with 4 years, 3 months.
Oh, yeah, it makes sense.
Is that right? So as I said, our principle here is that this leasehold improvement is spread over the remaining. If you see here, the deduction will be allocated over the remaining lease period from the date that the improvements are ready for use. Right, my friends? Can I proceed?
Yes, sir. Thank you.
Right. Legal expenses. Legal expenses, there are some prohibited legal expenses. For example,
hello, Eugene.
Yes.
Can I check something here?
Yes.
Do you take 3 months, just literally 3, or you count the number of days in each month to constitute 900?
No. We just count the full months.
But my question is based on 3. If you say 12 multiplied by 40, 12 multiplied by 12 is 48. I mean, 12 multiplied by 4 is 48.
Yes.
And plus that 3 months.
Yes.
So that my question is based on just a month in terms of single like 1, 2, 3 months.
Yes.
To get 51.
Hello? Yes.
Okay. So basically you don't take the full month, like February ends on the 28th, and then the other month.
No. We don't look at that. February is just like the same month as July, although the other one is 28, the other one is 31. They count them as 1 month.
Okay. But my question was based on the literally of the literal taken three as a unit. I mean, as a unit, 1, 2, 3. Because I'm taking 48 plus 3. I'm seeing that 51. I see where we get 51.
The issue here is the remaining period is not full years. Since it's not full years, that's why we have to convert it the whole period to months.
It's fine. We'll take it bilateral.
Yes. Does that answer you?
I'm saying I'm fine. We'll take it bilateral because my worry is we'll take it bilateral.
I can't hear you.
We'll take it bilateral.
I don't understand. Eh?
1-on-1.
1, not 1.
We'll take it 1-on-1.
You engage you sir, on the side.
Okay. I was not hearing you properly. Okay, sir. That would be fine. I was not hearing you properly there. Right. Legal expenses, my friends. If the legal expenses have nothing to do with the business, then they will be prohibited expenditure. For example, if you go to court suing an employee who did not pay a loan, there's nothing to do with their main business. So that will not be deductible. So we have to link it to the business. Right. Then here we're told that the legal costs have been incurred for drawing up the lease contract. That means these are legal expenses for the lease. So this can be deductible. But you should also know that if they are of a capital nature, normally they will be added to the cost of the assets sometimes. So that would depend. So these legal costs will be deductible because they were for the purposes of the business and they are not of a capital nature. So we have our legal expenses. $18,000. Right. Any service contract, 140. Barika made the following payments. IT support services and security services. Now, if you can see, IT support services and security services are deductible. They are deductible, both of them are deductible for tax purposes. But the issue is, if you can see, they were paid, our year of assessment is ending in August, in December, sorry. But they were paid up to August 2019. Whilst the security services were paid up to October 2019. So there were prepayments. And we know that section 23H provides a limit on the prepayment that can be deductible. Right, according to section 23H, prepaid expenses can only be deductible when one of the two conditions are met, either or. Number one, if the total prepayment is less than 100,000, then it can be fully deductible. That means the total prepayment, not for each expenditure. When you add them together, all of them, all your prepayments for all your expenditure, prepayment for rent, prepayment for salaries, prepayment for security services, if you add them, all of them together, if they are less than 100,000, they can be fully deductible in the current year, regardless of the fact that they are prepayments. That's number one. Or, remember I didn't say end. I'm not saying end. When we say all, in text, you should know that as long as one of the conditions is met, you don't have to meet all of them. So that means if the total prepayments are 100,000, you don't even have to look at the second one. It's fully deductible. Or if the services to be provided will be for a period of less than 6 months. That means if the prepayment is for less than 6 months, it is fully deductible again in the current year. Right, let me just quickly do the test for the 6 months. If we do the test for the 6 months, this was paid up to August 2019. That means there's a prepayment of 8 months, January to August 2019. Remember that our current year of assessment is ending December 2018. So there's a prepayment of 9 months, 8 months, January 2018 up to 2019 up to August 2019, which is 8 months. Right. And the security services have a prepayment of 10 months, January to October. So that means these prepayments, they don't pass the first test of 6 months because they are for more than 6 months. But remember, it's either or. So we still have to carry out the other tests. As long as they satisfy one of the 2 tests, then they are fully deductible. So the second test, we have to calculate the prepayment and see if it's for more than 100,000. Right, maybe let me do this. We can say IT support services for the year. Let's just, the one for this year is fully deductible. There's no question about it. Right, would say the IT services, they are our IT services 110,000 times 4 divided by 12. That one is deductible. There's no problem about it. What do we get? My 4 is coming from my friends so that you don't get confused. We're together here. They paid on September to December. So the months for this month, yeah, they are not a question. They will be deductible. Those ones are not a problem. The problem is the prepayment. So the September to December, the 4 months is deductible in the current year. What do you get? $36,667. Right. So this one, regardless of any other conditions, it's fully deductible. Then security services. Security services, it's what? 30,000. And it was from November. November to December is 2 months. So the one for 2 months is not even an issue. So we'll say 30,000 times 2 over 12. What do we get? Just a minute. Right. Thanks. Right. Then we deal with the prepayments now. Security services. The prepayment is 110,000 for the remaining months, 8 months. What do we get? Are you sure 20,000? That cannot be 20,000. This cannot be 20,000.
It's 73,333.
Yeah, that's more like it. Thank you. Right, then security service. This one was what? IT. Sorry. Maybe that. Oh, maybe the gentleman had put. I'm the one who made a mistake here. This one is IT support. I see why he made it. I'm the one who caused the problem there. Then security. Services. Would say what? 30,000 multiplied by 10.
Yeah,
If
it's
too much fall within our,
25,000.
that's the 20,000, isn't it?
25,000.
All right. Then we get the total prepayment. So you have to add all the prepayments. So you add up all the prepayments. Right. So we can say total prepayments are less than what? 100,000. Therefore, there is no section 23H prohibition. Is fully deductible. So we're going to subtract the full 98,333. So it departs from the accounting. Remember that in accounting, all prepayments are not deductible. But here now, we add up all the prepayments. As long as they are less than 100,000, they are deductible. And even if they are more than 100,000, but the services are to be provided within the next 6 months, they will still be fully deductible. For example, if this was 200,000, but the prepayment was only up to, let's say, March 2019, which is 3 months after year end, we're still going to deduct the full 200,000. So it's either or. So either if the total prepayments are less than 100,000 or the services to be provided are to be provided within 6 months, then the amount will be fully deductible. Any questions on that prepayment? So if our answer here was more than 100,000 or more, we're going to, it was not going to be deductible. We're going to apply the section 23H prohibition. So the 100,000 limit is not per item of expenditure. It's for the aggregate prepayments. That is the total prepayments for all the expenditures. Any questions, my friends? Right. Then our next item is depreciation. Right. We don't deduct depreciation for the sake of our tax assessment. Instead, we deduct capital allowances. We don't deduct depreciation. So we will not even look at this 33,000. But rather, we're going to go and check the types of assets and stuff like that. And remember that this is a small business corporation. Because it's a small business corporation, we apply section 12E. Because it's a small business corporation, we apply section 12E. And what does section 12E say? For manufacturing assets, remember that we provide 100% deduction in the year of purchase. Whether second hand or new, there's no distinction. As long as it's manufacturing machinery, we deduct 100% in the year of purchase. And if it's non-manufacturing machines, according to section 12E for small business corporation, they can claim 50% in the first year, 30% in the second year, and 20% in the third year. And we should know that Section 12E allowances are not apportioned. So even if the asset was brought into use during the year, that is, let's say in November, when the year is ending December, there will be a full capital allowance for the full year. Section 12E allowances are not apportioned. So it's 100% for manufacturing machinery for an approved process of manufacture. And it's 50%, 30%, and 20% for all other assets except buildings. The buildings, we apply the capital allowances for buildings. They don't differ between small business corporation and the other companies. Right. So now here, we're told that they bought a second-hand machine purchased for 80,000 on 15 June 2016. Right. So we have our capital allowances here. Right. For so your dates will be very, very, very important, my friends, when you are answering such a question. Right. They said that there was a second-hand furniture. Right. Your dates will be very, 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 very important. Right. This was purchased. Remember that our year of assessment is following the natural calendar year. That is the December. Right. This furniture is not a manufacturing machine. So it will not qualify for the 100% deduction. So it will qualify for the 50% in first year, 30% second year, and 20% in third year. This was bought in June 2016. And we are now in 2018 year of assessment. So in 2016, they claimed 50%. In 2017, they claimed 30%. So we're now in 2018, so they will be entitled to 20%. I repeat, for manufacturing assets, manufacturing machines, it's 100% deduction. So if this was a manufacturing machine, we're not going to deduct anything in 2018 because the 100% will have been deducted in 2016 when it was bought. But because it's a non-manufacturing asset, there will be 50% in first year, 30% in second year, and 20% in third year. And currently we're in the third year of the purchase of this furniture. Why am I saying third year? It was purchased in 2016 and we're now in 2018. So that's 2016, 2017, 2018. So we're going to have 20%. Yes, the VAT, we use the price excluding VAT. So we're going to say 80,000 multiplied by 100 divided by 115. You remove the VAT if the business is a VAT vendor, right? Then multiply by 20% because we're in the third year. What do we get?
$18,913.
Thank you. Sorry, let me put it in the last column. Right. Then next, we have new computers for the company we purchased for a total value of 65,000 on 1 September 2017 from a non-vendor. Right. Remember, if you purchase from a non-vendor, there's deemed VAT. So that amount is considered to be including VAT. Oh, sorry, it's new. It's new, so there's no deemed VAT. If you purchase a second hand, that's when there's deemed VAT. So there's no deemed VAT. Sorry about that. So there's no deemed VAT here. Deemed VAT only applies to second hand goods purchased from a non-vendor. So here it's new computers, so there's no deemed VAT. So and it's a non-vendor. So if it's a non-vendor, there's no VAT. So we'll just take it as 65,000. Right, but they were bought in 2017. This is a non-manufacturing asset. So we'll have 50% in 2017 and 30% in 2018. So we're in the second year, so it will be 30% because it's a small business corporation. So they have computers, $65,000 multiplied by 20%.
13,000, sir.
18,000, not 19,500. 18,000. My friends, if these computers were second-hand, they could have been deemed VAT. If you purchase second-hand products from a non-vendor, there's deemed VAT. So we're going to say 65,000 times 100 over 115. But because they are new, there's no deemed VAT. Right. Now, my friends, the binding general ruling, we only use it if it's a normal company. So if it's a small business corporation, then you know that you ignore the binding general ruling. But if this business was not a small business corporation, then we're going to apply the binding general ruling. If this business was not a small business corporation, then we're going to apply the general binding ruling, the binding general ruling. So please, if it's a small business corporation, you know that this one is there, but you don't use it. But if it's not a small business corporation, we would apply that. Right. Then we get our taxable income. We are done with all items now. We add up everything from the first item there. So that's our taxable income. Then we apply our tax tables. Remember that for this year, we'll be applying the tax tables from the previous year, which ended in March. Right, so income tax expense. We don't use the ones that we announced recently, which are applicable from 1 March 2023 to 2024. So we use the ones that are applicable from 1 April 2022 to 20 March 2022. Right, on this one, our tax, if the income is more than 929, if it's more than 550,000, the tax will be 58. Because light, if it was not a small business corporation, we're going to multiply by 28% straight. Then that's it. We're going to use the 28%, right? But because this is a small business corporation, it will be 58,013. This is according to the tables here. Plus 28% of the amount above 550. So plus 28% of 929,635. Minus the tables. Usually don't worry about them, they will be given in your exams. What do you guess? But sometimes in assessments they don't give you, but in the exam, final exam, they will give you the tables. So that 58,013, guys, it's according to the tables. It's on the tax table. Even the 550, it's on the tables. Small business corporations are taxed on a sliding scale from 0% to 28%, depending on your taxable income. Now, what do you get?
So I'm getting 164,311.
Right, thank you, sir. I think you are agreeing also with Roshan there. Thank you. Then remember, right, what I was saying when we started, if they say calculate taxable income, we're going to end here. If they say income tax expense, current tax expense, we're going to end here. Normally we call it current tax expense. If they say liability, like in this case now, we have to subtract what? Provisional tax payments. That we paid so far. Remember, we told that this company, they made provisional tax payments. That is 80,000 and 75,000. So say 80,000 plus 75,000. What do we get? I think 155,000. Right. Then we get the liability, what they owe at the end of the year. So the normal tax liability here will be the difference. So this is the amount that they are still owing us, which they have to pay so that they can clear their tax liability. Any questions? Right, I also wanted to do question 2, but please keep the question 2. We'll do it in our next class on Saturday. So I told you that we're definitely going, this week we're going to definitely have class on Saturday. I will tell you the exact times by Friday. So we'll have another class on Saturday. We just want to push so that you can be ready for the next test. Any questions? And please, I advise you to review whatever we have done before we meet, so that if there are any challenges, we can be able to ask them. Okay, thank you so much, ladies and gentlemen. Have a blessed evening.